friend of mine works for a multinational, and we were having dinner, and we were talking about ethics, and she said to me, you know, we'd like to do more, but the investors won't tolerate it. The shareholders want, profits to rise every quarter. What can we do? So I'm going to give you the perspective on ESG and emerging markets from an investor. I'm one of those guys. And so I'll talk about setting the stage of why this makes sense to an investor. I'll talk about qualitative investigation into ESG and how it complements quantitative. Then I'll talk about how one can find alpha responsibly, what some of the drivers are, governance and social, and then finally, like any business presentation, what does it cost? So, back in the old days, before any of us probably were involved in business or anything, the purpose of business was seen as the improvement of society through commercial endeavor. But we've had the intervention of Ayn Rand, Milton Friedman, and Gordon Gekko, and now anything other than maximizing profits is seen as quaint. We think business needs to discover its moral compass. Limited liability doesn't mean responsibility can be completely avoided. Ownership of companies involves some responsibility for their actions. You can buy the stock of a polluting company, but that supports their share price. It lowers the company's cost of capital, and it makes it easier for them to expand. So as professional investors, being aware of this potential damage is part of managing risk. Engaging companies to ameliorate this harm is part of being a good human being, but it's also part of being a good asset manager. We don't think these two identities should be separate. French asset owners tend to be at the vanguard of engaging with their companies. But at Hermes, we practice this as well. Our emerging markets team of 9 professionals managing $3 billion in emerging markets has an ESG component in all of our analysis. And contrary to the received wisdom that ESG and engagement lie outside the paradigm of shareholder value, and indeed represent an additional cost to portfolios, our analysis demonstrates that integrating these decisions into stock analysis actually enhances risk-adjusted returns. Upon reflection, how could this not be the case? In this age of the internet, information spreads instantly. The costs of pollution, mistreatment of staff, and poor governance are increasingly obvious to everybody. Now, normally, traditional ESG investing takes a best-in-class approach. You screen a universe on ESG characteristics and credentials, and then you select stocks through a quant process or through stock picking within this constrained universe. We think, however, it's important to go beyond scoring if you want to really find the upside from investing responsibly in emerging markets. Scoring and thereby rating the ESG characteristics of this type of portfolio is more straightforward in the developed world. In emerging markets, disclosure is patchier. The depth of coverage by rating companies can vary quite a bit. And some providers actually are in read-only mode. In other words, they rely exclusively on published data that may not exist for mid and small cap companies in emerging markets. Also, the dynamics of the ratings can skew the results. There are very significant methodological differences between providers. This sacrifices clarity and oftentimes sacrifices the consistency of analysis at the stock level. This may result in scoring against shifting or inappropriate benchmarks, which in turn can produce misleading results. Specifically, many ranking tools are sector neutral. We manage a positive impact fund in the US, which isn't sector neutral. It has minimal exposure to energy or mining, and thus currently is around the top decile in terms of its carbon footprint, very, very low. But it's penalized simply because it doesn't own the best of the worst, or oil producers that score better. And as we've seen, reported data in emerging markets is quite unreliable. So the state of the art of assessing ESG at the company level, much less the fund level, is immature. We believe that the quality of the analysis that goes into in-depth research should count for a lot more than a ranking based on debatable weightings of factors that are actually pretty difficult to compare, such as gender diversity, a weighting of gender diversity versus a weighting of carbon emissions. How do you actually weight those two? Now, let's talk about how do you find responsible alpha in emerging markets. If the client, if their primary requirement is the generation of alpha, we believe it doesn't make sense to do ESG first. That's restricting the investment universe drastically. It's almost like investing backwards. We, on the other hand, since our job is investing, we look for great companies at a reasonable price. Of the 33,000 listed companies in emerging markets, we screen down to 3,000 liquid ones, and we look for the top 1 or 2% that exhibit sustainable growth, excellent management, strong balance sheets, good profitability, and that can grow their cash. Then we determine if the valuation is inexpensive for a temporary reason, or if there's a permanent reason that the stock is cheap. Only then do we look at ESG, partly to become aware of hidden liabilities. We have a dashboard that pulls information from Sustainalytics and other sources, and it assigns scores to various factors. We also consult the Hermes engagement team, which is 26 people who advise on $270 billion of pension assets, on voting at annual meetings. They engage, and they work with legislators and regulators on public policy. Finally, our team does its own digging, talking to locals, scanning the local press, trying to get perspective from the local community on the company and its management. In emerging markets, companies often suppress information about employee illnesses from manufacturing, for example, so it's important to dig this out. The active stock picker's in-depth knowledge is what makes the difference, we think, in emerging markets. So what are some of the drivers for investing that can help you generate alpha from ESG? Our research shows that the companies with the worst corporate governance tend to underperform. Now, corporate governance is about maximizing value for all shareholders. So here we put aside the discussion on the benefits for the wider society, and we focus on the protection of minority shareholders' rights. Subject and subordinate to the will of dynastic family and state ownership, foreign minority investors in emerging markets have consistently applied a governance discount to stocks with conflicted management. We've learned to be initially skeptical when researching companies, especially if the state owns a large proportion of the shares. As seen recently in Brazil, government shareholders directed energy, utility, and banking businesses towards national or party projects that were against the interests of minorities. Frankly, probably against the interest of the company as well. In Russia, oil and gas companies have invested to further state agendas. Government-appointed executives tend to run many of the larger index stocks in China, often neglecting returns and doing the government's bidding. The track record of emerging markets in governance, while providing little scope for enthusiasm, does have one silver lining. It provides a lot of room for improvement. We're seeing a lot of examples of positive developments, although granted from very low levels. And these positive developments come from an in-depth review of the company's business approach, often coming from an engagement program. The direction of travel can actually have a significant impact on performance, both financial and social. This dynamic further demonstrates the importance of moving beyond mere and static scoring. The point is, engagement really does count. Often, the specific area where emerging market companies fail is capital discipline. This results in less excess capital returned to shareholders through dividends or share buybacks. This is due to two prevailing definitions of excess capital. In the company's view, there's never any excess capital to return to shareholders. In the minority shareholders' view, there's always plenty. This difference relates in part to diverging understandings of what is the cost of equity capital. In addition, the motivation for undertaking projects may range from providing jobs for family members or jobs for the electorate, neither of which are priorities for investors, nor do they add value to the company itself. In exploratory meetings with an overcapitalized state-owned enterprise or a family-controlled business, a telltale sign that our interests will remain ours alone often arises when we suggest increasing the payout ratio. At this point, the chief financial officer might start laughing, so we'll enjoy the moment and then move on to another investment idea. Sometimes businesses in emerging markets are discounted too harshly and offer short-term trading opportunities. For example, many investors are currently exposed to a large Asian conglomerate, which makes phones, having judged that in spite of the very modest growth outlook for their product, some of the enormous cash pile could be returned to investors. And the company's recently announced share buyback will go part of the way to restoring confidence. This follows the government's prodding of family-owned businesses to respect minority shareholders' rights. Similar government pressure has been applied to oligarchs in Russia as well, with just the bare beginnings of some progress there. Generally speaking, in my universe of emerging markets, Taiwanese companies generally have good governance. Taiwan Semiconductor is a good example. Their payout ratio is high, the company gives clear guidance and deep insight into its business, and minorities are treated fairly. As evidenced by the previous example, Korea is pretty much the reverse, although it's changing slowly. The Chaebol have controlled companies with very small shareholdings. They've engaged in corporate restructuring in order to cement further family control, and they've exhibited little, if any, capital discipline, with low payout ratios and low levels of profitability. Hyundai Motors, for example, recently spent $10 billion on a new corporate headquarters in the Gangnam district of Seoul, ostensibly to make their engineers' commute easier. But governance isn't the only driver in emerging market companies. The social aspect also matters. It can be a proxy for management quality. In the mid-90s, I was running an Indian smaller companies fund. I went to southern India to visit SIV Industries, a business that made rayon, fabric used in clothing. Rayon is made from purified cellulose mixed with sulfuric acid. The company in which we were invested was generally seen as a good company and a reliable supplier. But visiting the plant was an alarming experience. The acid from the slurry was dripping and spraying onto the workers' feet, and the workers' feet were bare. Management maintained that they were powerless to force the workers to wear industrial shoes, and it was pretty hot in there, to be fair, because there was no air conditioning, it was just windows. So worker safety was not their responsibility, as they'd done as much as they could. This bothered us enough to sell the stock. Now, it transpired that worker safety was not the only responsibility that SIV had neglected. 2 years later, it emerged that the company was dumping effluent into a nearby river and was forced to shut down. More recently, a diamond miner in South Africa answered our question about employee living conditions with an assessment of the living conditions for their housed workers. This led us to ask about, what about the unhoused workers? The miners that were living in shanty towns and lean-tos on the property. For this, we asked them how they could tolerate these kind of conditions for a number of their workers. They didn't have an answer for that. For this and other reasons, we divested of the stock, but we weren't surprised to hear, along with our results announced this October, serious lapses in safety in the mines themselves, along with 4 fatalities. So, what does this all cost? Some say that returns for ESG funds have been worse than for non-ESG funds. This is just simply not true. MSCI's ESG Emerging Market Index has outperformed the non-ESG index. Plus, when you add engagement, ESG funds can actually help companies behave better. Petrobras in Brazil used to have a terrible governance and record and a very poor environmental record. Hermes was part of a group of investors who succeeded in appointing 2 independent directors to represent minorities on the board. The crisis happened anyway. They were powerless to prevent the government corruption that was taking place, but now they've gained power under the new regime, and they're cleaning the company up. Chinaman Udary, not a household name in France, but their ESG went from really terrible to good. Previous management cut corners on safety. In 2008, their milk tested positive for melamine, and babies died. Other problems followed. The Chinese government then fired the management and brought in executives from the Danish dairy company Arla and from Coca-Cola China. These executives spent a lot of money to make sure the milk products coming out of their facilities were 100% pure. A lot of investors took the guidance that the management was giving, that they would spend a lot of money on safety, as a negative indicator for the stock. We took it as a positive indicator because we knew eventually they'd have a franchise which would be powerful. As more investors identify themselves as long-term owners of companies, and as digital technology makes corporate activities increasingly visible to a larger audience, ESG analysis is becoming recognized as an important concept whose time has come, even in emerging markets. In several years, we think that having the expertise to integrate these risks into valuations will not be the exclusive domain of specialist fund managers, but will be integral to the decisions of mainstream investors.